Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Yeah, and you mentioned something, so I'm gonna divert a little bit now. We talked about a typical land developer. We want to develop land, sell it to builders. We're off to the next deal. Summerlin or Howard Hughes has a much different business plan, and I'm going to talk pre 2025, post 2025. When I started working with you guys in the early 2000s in Summerlin, and I learned what the business plan was, it was kind of like, oh, wow, that is really cool. I never thought of it like that because I'd never worked with a developer that had the business plan that you all had. Could you explain to our listeners the business plan Howard Hughes has and to some degree or had pre 2025, and then we'll talk about the segue into the new strategy, because I think that'd be it's really important for our listeners to understand what that plan was or
Absolutely.
is.
So our plan, revolves around, driving long-term value creation, right? And at
Hmm.
the end of the day, it becomes, if you do it right, a self-fulfilling, you know, value creation cycle where I sell land to home builders. I take that money and I use it to build incredible amenities in our communities. And sometimes those are ballparks or shopping centers or
Hmm.
office buildings or multifamily buildings. And we build those commercial amenities at outsized risk adjusted returns because we're building them in communities where we have unique control.
Hmm.
Carter, we talked at the beginning about the risk of developments. It was entitlements and competition.
Yeah.
I don't have entitlement risk and I don't have competition.
Yeah.
So when I can build without competition, I can get better returns.
Yeah.
But building amenitizes the communities such that more people want to live here.
Hmm.
Home values go up, my land value goes up. I sell that land to home builders at a higher and higher value, which generates more capital that
Hmm.
reinvests back into our
Yeah.
community to build the office and multifamily and ballparks, et cetera. And that cycle goes on and on. And I did Investor Day, I guess it was earlier this week. My God, the days are blending together. It's a long week.
I know how you feel. Yeah.
I said in 2017, we had our first Investor Day, and I showed everyone on a discounted basis the value of our undeveloped land across our master plan communities.
Hmm.
It was $3.7 billion.
Wow.
And since 2017, we've sold $2.1 billion of land.
Uh-huh.
All right. So math would say, hey, 3.7 minus 2.1 leaves you 1.6.
Uh-huh.
But using the same discount rates and all the same assumptions, the value of our remaining land is worth $4.3 billion
Wow.
because the price per acre has appreciated so
Yeah.
greatly from the constant reinvestment and the constant putting money back into our communities
Right.
that the value of the remaining dirt, that melting ice cube that everyone's worried about, actually got bigger.
That's kind of math you like. Now, when you're selling and you're building your amenities, but you're also taking that and you indicated that you're building commercial retail buildings
Mhm.
that you're controlling and owning. Is that a correct statement?
So for the certain asset classes, we believe having a dominant market share in these communities provides outsized results.
Yep.
Office, right? If people are going to make an office decision, they're making a 10-year decision. It
Hmm.
really matters where your office building
Yeah.
is,
Yeah. Yeah.
right? And you're not changing it every 6 months. So that if you own the dominant share of Class A office in a community, your
Mhm.
results will be better in good times and bad.
Yep.
And we have a mindset that allows us to control the vast majority of the Class A space in all of our communities.
Yep. Yep.
Same holds true for multifamily. Where I live for a
Yeah.
year matters,
Yeah.
and I will pay more to be in a great location.
Yep. Absolutely.
Um, Core downtown retail that creates a sense of place that helps create the fabric of a community, really important to us.
Yeah.
Other asset classes, less so. I'll give you
Yeah.
a classic example. Once upon a time, we owned all the hotels rooms and the hotels in the Woodlands.
Yeah.
Hit a downturn, and rates are down. And if you're making a one night decision and it's $50 for a 5 minute ride down the street cheaper, you're going
Yeah.
to take that 5 minute ride, right?
Yeah.
There's no benefit of owning the hotel rooms in the
Yeah.
Woodlands market the way there was for office and multifamily. So for those other asset classes that are not office, multifamily, or downtown core city center retail, we'll build and sell or contribute our land to a developer to build, but we don't see a competitive advantage of owning those for the long term.
Yeah, yeah. And so are there opportunities that do you look at your portfolio every year, every 5 years, every 10 years, or very opportunistic? Do we want to sell it? Or are you pretty well committed to holding those as long-term assets indefinitely?
Oh, we're committed to holding those assets
Yeah,
in
yeah,
perpetuity. It's just
got it.
the unique control insulates us through market cycles, and we're not
Yeah,
immune, but
yeah.
we are very much insulated as a result of our ownership.
Great, great. And that was the thing that I found so interesting because most of my developer clients that I've worked with around the country, they sell the commercial off, they're off to the next project. And it just clicked with me, just going, God, this is a beautiful, beautiful model.
It
And
takes a long-term mindset and
yeah.
discipline and patience because that profitability of selling those commercial assets is so tantalizing.
And
Um,
and 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 so and this gets back and or I'm gonna dovetail back to the business plan. But when you're running numbers on these large scale master plans, you want to have a risk adjusted return, and ultimately you want to increase the shareholder value, which you're doing. But how does one really look at these long-term assets that are going to be with you forever? Because if you're discounting those back 20 years, there's not a huge impact in value, or is there? How do you do the math? I'm just kind of curious on that.
yeah,
We'll
so
have to
like
geek out sometime when I'm in Houston because I'd love to sit down with you and Andy, yeah, with
yeah,
Drew
so
rather.
look, as we thought about underwriting and as we look at new master plans, we very much look at them as on an unlevered basis, right?
Okay. Yep.
And I'm not throwing stones at anybody else, but I don't think land is an asset that should have debt on it ever.
Yeah.
Like assets that should have debt should have cash flows to support
Yeah.
it.
Yep.
Land has no cash flow.
Yeah. No,
It shouldn't have any debt.
just going
So
out. Yeah.
yeah, so and as we're looking at kind of a 40-year model, it's less about IRR. I mean,
Yeah.
because I've never paid a bill with IRR or ate dinner
Yeah.
on
Yeah.
IRR. It's
Yep.
multiple capital.
Yeah.
And if we take what we think is a conservative approach and we look at the commercial land as all, you know, non-income producing commercial land. So if we
Uh-huh.
think of the commercial land in a community as police, fire, water
Yep.
treatment, churches, schools, and don't sell it, or develop it, and we are in approaching that 15 to 30 times multiple of capital over the life,
Yeah.
that's a good deal.
Yeah.
We like that.
That's it. Yeah.
And for us, it's like if we can get those returns over a longer term hold, knowing that the real value, the real juice comes from the commercial development.
Yeah.
If it stands on its own without the commercial development, then we've got a really good one.
Right.
And Terra Vallis is like that. I mean, when we announced that deal, we told the world we paid $17,500 an acre.
Yeah.
And on our most recent earnings call, we announced that we've sold our first 1,000 lots at $750,000 an acre.
Yeah.
It's a good multiple of capital. I mean, no, granted, we had to put money into the
Yeah.
dirt, right?
Yeah.
So it's not all profit,
Yeah.
but it's an amazing profit margin when you think about that. I can develop land and sell it at a 60 to 70% margin for 40 years.
Yeah.
That's a really good business. And part of the reason why that is available is the areas that we're developing have thoughtfully structured municipal financing
Yeah.
available.
Yeah.
And
Pete.
when I say thoughtfully structured, like because there's been a couple of states that have had really bad municipal debt structures
Yeah.
that have blown up, right? So they're
Yeah.
not all created equal. But if you
Yeah.
have a good structure in place where you can be reimbursed for the infrastructure that you're putting into the dirt, you can sell land at an incredible margin.
Yeah. Yeah. And you're preaching to the choir on that one, but would there be any way to develop a large scale master plan community such as Howard Hughes is doing without the use of some sort of special district financing?
No,
Yeah.
no.
Yeah.
Well, could you? Sure. But I think that it would destroy the affordability of the housing
Yeah.
that makes those communities attractive,
Yeah.
right? There's a reason why you can get twice the house for half the price in Arizona than LA,
Yeah.
right? It's thoughtfully structured municipal financing, right?
Yeah.
every affordable market or more affordable market, I mean, because I know some will argue that nothing's affordable these days, um, is the beneficiary of good municipal financing.
Yep. Agreed. So thanks for that. Thanks for that plug, David. Now, the other thing I just want to remind the listeners is you can't eat IRR. You heard it from David. Yeah,
I've never paid a bill with
but cash
IRR, right?
flow and nominal dollars you can. So the first question that I always ask our clients, what is the vision of your community? And by the way, are you IRR driven or are you nominal dollar or multiple driven? You only can pick one because that's going to dictate the way we're going to help finance your community. Obviously, all the publics are IRR, period, end of story. Very occasionally you'll get guys saying we're nominal or multiple, but it is so I just want to point that out to all of our listeners and what so really pay attention to what David was saying.
Yeah, one of the
Uh
things that I learned early on at Lehman Brothers in investment banking and working
yeah.
for hundreds of hours a week in Excel is I can deliver any IRR you want, right? I'll
Exactly.
just tweak some assumption. Like it's
Yeah.
easy, but it's really hard to change that multiple of capital because
Yeah.
the cash flows are the cash flows, right?
Yeah. Exactly. And David, I wanted to be a civil engineer until I found out all the math I needed to know. So kudos to you. So I became a CPA. I can add and subtract.
Yeah.
But yeah, I always tell everybody, they ask you, what are you? Well, we're financial engineers. But to your point, you can manufacture any IRR on an Excel spreadsheet that you want. It's just a matter of can you hit it, to your point, and generate that cash, which is
Mhm.
very difficult to do.
Absolutely.
Uh, so let's dovetail now. I heard that you guys got a $900 million investment from Pershing, and Mr. Ackerman is back, and now you're as the chairman. How has the view of Howard Hughes changed? And what are some of the new aspects of your business plan that you're going to be rolling out post the investment from Mr. Ackerman and Pershing Square?
Yeah, I think most importantly, Carter, is that the business strategy and philosophy that we've spent a little bit of time talking about
Yeah.
today, as it relates to Howard Hughes Communities, our real
Yep.
estate subsidiary, doesn't change.
Yep.
And Bill has been around this company since the day it was born.
Mm-hmm.
Right? He took control of General Growth Properties, which was heading towards bankruptcy. He owned 25% of the common stock
Yep.
and saw this collection of master plan assets in a public mall REIT and said, this doesn't belong. And Howard Hughes, and he's been, part of the architect of the strategy that we've talked about for
Yep.
10 years.
Yeah.
None of that changes. He's an
Yeah.
incredible fan of what we do, how we do it, and doesn't want any of that to change. What we do want to do is convert Howard Hughes Holdings, our parent company, if you will,
Mm-hmm.
into a diversified holding company and mimic the structure that Warren Buffett did at Berkshire Hathaway.
Yeah.
Now, the difference here is that we're much smaller, obviously, but
Yeah.
even if I rolled back the clock to the early days of Berkshire Hathaway, it was Warren Buffett buying a failing textile company
Mm-hmm.
because textiles were getting offshored and
Yeah.
largely
Yeah.
moved to Asia,
Great
and
story.
using
Yeah.
that cash flow to invest primarily in building an insurance company.
Mm-hmm.
And I think very early on, my suspicion is that Warren Buffett saw the best way for permanent capital, a public company, to invest in other public securities that's not regulated by the Investment Advisors Act of 1940 was to
Mm-hmm.
own an insurance company.
Yeah.
Because the float of an insurance company, if done structured appropriately,
Yep.
can be invested heavily in equity securities
Yeah.
without that regulation.
Yeah. And so that is the shift you're making, everything as is for Howard Hughes Communities,
Yes.
but now we have a holding company and we're going to model ourselves after Berkshire.
Yes, and initially
That's
that
great.
$900 million that Mr. Ackman invested is going to be used to build or buy an insurance company. But Howard Hughes Communities is at a pretty unique inflection point as a real estate subsidiary.
Yeah.
To date, for the first 10 years that I've been with Howard Hughes, we've invested kind of 100% of our free cash flow back into our communities.
Yeah.
right? But when I started 10 years ago, we had about a $80 million run rate NOI of recurring income from office and multifamily. And
Yeah.
today it's 265.
Wow.
We were
Yeah.
selling land to home builders at profitability of 180 to 200 million. And today it's 430.
Yeah.
And we
Wow.
were hoping that maybe we'd build a condo business that could be successful. And today I have $4 billion of condominiums under contract at a 25 to 30% margin that are going to close over the next 5 years. So if I
Wow.
look at our free cash flow, that today we've guided to about $430 million. Over the next 5 years, that 430 grows to close to 700 million. And if I leverage that at 2 to 1, that's $2 billion to invest in development back in our communities. I have really talented developers at Howard Hughes.
Yeah.
They can't come up with that many ways to spend my money, right? That's too
Well,
much.
well,
So
speaking of that, what's the status of my $40 million condo at Ward Village? Is it done yet?
well, we haven't even started construction, Carter. We sold, as you noted, from the
Yeah.
Wall Street Journal article, we sold 1.2 billion, which has now grown to 1.4 billion off of renderings,
Yeah. Yeah.
right? And
Incredible.
in Hawaii, we get 20% hard deposits that are non-refundable, and we can use those deposits as our equity in construction.
Yeah.
So our most recent tower, Victoria Place, that we closed last year, it was a $500 million project that generated $200 million of profitability. Our peak equity in that project was a little bit less than $40 million.
Oh, jeez.
It is one of the best
Yeah.
multiple of capital investments I've seen in my real estate career, but it took a while. You had to build that
Yep.
credibility.
Yep.
And unlike I think a traditional condominium developer that has a tower and sells it, moves on, we're
Yep.
building a community. It's
Yeah.
just vertical instead of horizontal.
Yeah. Yeah.
Instead of 36,000 acres, I have 60. But that 60 acres is incredibly well manicured, thoughtfully curated with great green open space,
Yep.
wonderful retail amenities on the ground floor, private security that keeps our residents and our neighborhood safe.
Yeah.
It's community building, but vertical.
Yeah. Yeah. And that's a recurring theme. Community, community, community. And building that community enhances the value, which allows you to do many more things, build that team. And speaking of teams, so you've got to just, from everybody I've met at Howard Hughes Communities, fabulous team. Now you're getting into maybe the insurance business, get that float, go start investing it in and expanding the holding company. Is there another team that you're building, or did you inherit, or how? Because it's a different mindset, a different skill set. How are you building that team as you go look at investing uh, money for the holding company?
Well, as we look at new investments and whether it's, in all likelihood, buying an insurance company, um, the things that are most important to us is buying companies with great management,
Yeah, just
right?
like Buffett, and just
Absolutely. And, we may change the investment philosophy on how we invest the cash of the insurance
yeah,
company. But we're not going to change the way we underwrite policies and invest if we have a great management team that's been very
yeah,
successful in reinvesting into writing, good policies, right? So that is always first and foremost as we look at, buying companies, and we're focused on, insurance business, but companies that are what we describe as durable cash flow businesses
yeah,
that are somewhat resilient, have competitive moats, and provide the opportunity for long-term growth and free cash flow.
yeah,
And I think that we're in a unique position because if you've built a business your whole life and you have a family business and you put your blood, sweat, and tears into this, your opportunity to sell that business someday is kind of private equity,
yeah,
right? Berkshire needs like, a $10 billion acquisition to be excited, right?
yeah,
They don't need a $400 million rounding
yeah,
error. So, and if you sell to private equity, you're kind of going on the 5-year merry-go-round. Every 5 years, you're going to be
yeah,
sold, and private equity is going to squeeze your
yep,
G&A and fire your
yep,
family, and maybe move the company out of your hometown that was
yeah,
very critical to you. Whereas if you came to us, we're going to just leave you alone.
yeah,
Just continue to run your business really well. We're never going to sell you. We're going to own you forever. And we if anybody believes in what the business means to a community, it's us, right?
yeah,
So we're not
yeah,
going to move you as much as I want to move everyone to the Woodlands or
yeah,
Summerlin. No,
yeah,
it's kind of a much different mindset, and I think for
right,
a seller, it gives us a competitive advantage than squeezing that extra penny and selling to private equity.
Right. So I'm going to put your email address in here. So if anybody has a $400 million company that they would like to sell, you can call David.
I have no, it is a very long list right now. I will say that for the next year or so, we're very much focused on the insurance business. And I
Yes,
think if we
sir.
get our
Yeah.
head picked
Yeah.
up out of the water from buying that business, then we'll start to focus on the next round.
Okay. No, fair enough. Now, for some of our aspiring developers that are listening to this podcast, and David, I just got to say thank you. I mean, just some of the pearls of wisdom that you've thrown out during this podcast are
Oh, I
awesome.
just think it's really good BS, Carter. I don't know that it's any pearl of anything.
But there, I truly believe that in large scale master plan, there are some just 4 or 5 basic concepts, that if you understand, will help you. But more importantly, you have to be able to execute on them. And that's the hard thing because it's easy to get distracted and do things that you probably shouldn't be doing. And that's where bad things happen.
Yeah, no, those shiny objects that, oh, look at this. It could be really great.
Yeah, yeah,
Boom, right? Oh,
yeah. So what have been some of, what has been one of your best uh learning lessons that you've had over your career from starting out as a civil and realizing I don't want to be a civil to, where you're at right now? Is there anything you would share with the listeners?
yeah. I mean, look, I think that there's a couple. Like one, always approaching any problem with a creative problem solving approach. We talked
Yeah,
about that. I think I had another great mentor in Jim Heastan at Parkway, and before that, a couple of other companies, Eola and Dasco, and a number of companies that he built and
yeah,
sold throughout the years. That he had an incredible way of looking at a deal from everybody's perspective. Like if we had 4 people at a table, he would see what the other 3 at the table needed out of that deal and
hmm,
find a way to structure it in a way to get them that met their needs and still solve for a deal that
yeah,
we liked.
yeah,
And I think a lot of times I see people come into a negotiation and it's fight and claw and scratch for what I need.
yeah,
And
yeah,
sometimes the best way to get what you need is to solve for everybody else's needs. And
yeah,
and that was just a different mindset and an approach to a negotiation and a way about looking for opportunities that has stuck with me forever and ever. And if there's one other, it's build, design, think about your master plans with great alacrity, flexibility.
yeah,
The only thing I know for sure, like I said earlier, is it's wrong,
yeah. It's
right?
gonna, it's
I only
gonna
have I
change.
have
Yeah,
2,000 residential acres remaining here in Summerlin, and I think I know where the roads are going to go, but I'm wrong, right?
yeah,
Because in the next 10 years, consumer demand is going to change,
yeah,
and we're going to have to adjust, improvise, adapt, overcome to meet those changing
yeah,
demands and needs of our consumers.
yeah. And yeah, you mentioned something, and when we're talking with cities and jurisdictions, I firmly believe that when we're talking with them, I say all progress begins by all of us telling the truth rather than posturing and positioning. And city, tell me what you need. What's important to you. You're telling it all of this stuff over here, but I
Hmm.
don't think it's really true what you really want. Let's get to what you really want, because then we can start crafting the transaction into what you were saying. So we're solving everybody's problems. We're helping them feel comfortable about what we're moving forward with. So
Absolutely.
yeah, I think that was awesome. Uh, as we're getting close to our time, is there any questions that I should have asked you that I didn't, or any parting insights you would like to share with our listeners, David?
I don't know if there's anything that we've left unscratched.
Okay.
I think we've kind of been around the whole portfolio and kind of how we approach things and the exciting opportunities are ahead of us. I mean, I think that the most difficult, challenging, and where I spend the most time as CEO of a
Yeah.
company that owns diverse master plans is on airplanes kicking dirt,
Yeah.
talking to residents. Like you can't run a business like this behind a Bloomberg.
Right.
You have to be out there.
Yeah.
And out there in terms of seeing your community, meeting your residents, understanding what they need, and meeting other companies chasing those relocations, because bringing jobs to a
Yeah.
master plan is the holy grail of value creation,
Yeah. Yeah.
right? A 10,000 square foot user that doesn't seem all that sexy is, 500 jobs. That's 500 homes and 500
Yeah.
seats in
Yeah.
restaurants and 500 people shopping in your retail and a
Yeah.
couple, 100 multifamily renters, right? That is the most important driver of value creation. So,
Right.
and there's only one way to get a CEO to move. It's to sit in front of him, shake his hand, and convince him to come look.
Yeah, absolutely. And I know that's a real big push at Teravalis right now. Obviously you've got a great uh, a, a great piece of land to be able to build that vision, build that community, and bring those jobs, into Buckeye, just like you've done everywhere else.
Yeah.
Are you still looking in? Another question. So you got 2,000 acres left in Nevada, which is, you're going to blow through that here pretty quick. You've got the 40,000 in Arizona. Bridgeland and the Woodlands, you have Woodland Hills, but you're starting to, come near the end in terms of the large scale master plans. Are you looking in other areas? And if so, what states are you most interested in? If I can even ask
Yeah.
that question.
Well, so before I answer that question, Carter, let me just go back and clarify something, because in your question, you said that we're nearing the end
Yeah,
in some of our communities, right?
good,
Right. And
good
and
point.
that is a common perception. I have
Yeah,
no residential land left to sell in the Woodlands. I must be near the end.
yeah,
But of the 28,000 acres in the Woodlands, I have 700 commercial acres that are undeveloped. Like, that's
yeah,
20 years.
exactly.
And
My fault.
everything that has been developed that we
Yeah,
may or may not own today, a lot of which has been sold because it didn't fit into the core investment strategy we
yeah,
talked about earlier, is deed restricted.
yeah,
It can never be a different use,
yeah,
size, color, setback than what it is today without the permission of the master
yeah,
declarant, which is
yeah,
us.
yeah,
All of those are growth opportunities for the next 50 years.
yeah,
That single story tilt lab research building is now on a great corner for a 30-story multifamily or condo
yeah,
development. And there's only one company that can unlock that value.
yeah,
It is a never ending opportunity to drive
yeah,
value. And there's no better example of this than the Irvine Company.
yeah.
Don Brenner's been out of residential land for what, a
Yeah,
decade?
it,
Hasn't stopped figuring out ways to make money.
exactly. And I'm in Irvine right now, and so that's exactly what they're doing. Yeah, I mean, they're tearing down the industrial, and it was a good use for the last 20 years. It's not a good use any longer. Yeah,
Absolutely. So you're never done with a
yeah,
large scale master plan.
yeah,
And to that end, I would tell you that with 40 years of dirt to go and 80,000 undeveloped opportunities and
yeah,
80,000 square feet of entitlements just to scratch the surface and 36,000 of undeveloped acres across the entire portfolio, I don't need another great master plan to stay busy.
yeah.
And I think that you'll more likely see us invest our free cash flow in our existing master plans
Okay.
and in other businesses from Howard Hughes Holdings
Yep.
than you'll see us invest in another master plan.
Yeah. Wow, this has been awesome. I mean, and to our listeners, I made the mistake of thinking you're out of residential land. You need a new master plan.
Well,
I had
no,
a
no,
lesson
like,
today.
look, we're out of residential land in the Woodlands, and we're
Yeah,
bringing the condominium expertise from Hawaii there.
yeah,
We launched the
yeah,
Ritz-Carlton,
yep,
and we sold 60% of that in 5 days at the highest price per square foot in the history of the state of Texas. So there's always residential opportunities. They're just in different formats.
yeah. No, that's great. David, thank you so much for taking the time to speak with us today. I really appreciate it. And to our listeners, if you've enjoyed this podcast, I encourage you to subscribe wherever you get your podcast. And David, thank you very much for taking the time.
It was my pleasure, Carter. Thank you.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcast to never miss a new episode.